Welcome to A Course to Retirement with Grand Rapids Certified Financial Planner Ron Corser. Ron Corser and Associates are planning today for the potential of tomorrow.
Welcome into the program. This is your Course to Retirement Grand Rapids, your resource for that common sense approach to planning for your financial, investment, retirement future. He is CFP Certified Financial Planner Ron Corser, once again here with us, helping us navigate and chart that course to retirement. Ron, welcome back in.
Good morning, Peter, and good morning, everybody listening to today's program. We have an interesting way to start today's program. We're going to talk about things that I don't like to eat.
All right.
What do I mean by that? I could list them in my least favorite things to eat. One is liver. I know some people out there listening today love liver, but I always figure if God had meant me to eat liver, he wouldn't have given me taste buds. It's one of those things. When I always hear it and people say, well, if you just cook it just right. And my response is, whenever I hear that about a food, you have to cook it just right. I don't want anything to do with it. Another form of vegetables that I don't like, my mom used to make me eat this one, is yellow wax beans out of the can by Del Monte. My mom loved those things. And me, just talking about them gives me a queasy feeling. Like most kids, when I was about 10 years old, I love my mom dear, and I don't think she'd mind me telling this story. We had that meeting that all parents have experienced where their child says, no more, absolutely not. And my mom said to me, if you don't eat those, you got to stay here. Well, I sat at the dinner table till almost 9:30 at night. And finally she said, go to bed. And she never brought up those yellow wax beans out of a Del Monte can again. And then the other one that I don't like at all is Brussels sprouts. And there's nothing you can do to Brussels sprouts that'll make me think anything, it's another one if you cook them just right. So those are the kind of things that lurk in the back of my mind, and I'm probably scarred forever with being forced to try to eat those things. So what are we going to talk about today? We're going to have a great program today, talking about something that I think is really important, and it's also going to be, I think, enlightening for a lot of people, and that's called annuities. And we're going to follow what Kiplinger put out recently when they talked about annuities. And their headline, and this is a great headline, annuities may just be the broccoli of retirement planning. Now, I happen to like broccoli, so that's why I'm doing today's program, because that's okay with me. But there are a lot of people. I remember President George Bush, the elder, said, no, you can't make them eat broccoli. So we're going to talk about these kinds of things. And try to put it into context. Why would I bring up a specific kind of place to put your money and spend basically the whole program with it? There's a couple things that work. Number one, and everybody knows this, we live in interesting times. There's a Chinese proverb that says, may you live in interesting times. And we're living in interesting times economically. Sure, I'm not talking about politically, although that could influence the economic part of it. But everybody that I have as a client, everybody I've talked to over the last 6 months to a year are worried about two things. Am I going to have enough money in retirement, income in retirement to retire? Or if they're already retired, is my income pretty firm? Is it guaranteed? Am I going to be okay 10 years from now with income? And so those two questions are really important for people to answer, whether you're thinking about retirement and you're 45 or 50, or you're in retirement. That's why we're going to talk about annuities today. So think about this. Few of us would ever go without buying home, auto, life insurance, medical insurance, because that insurance protects us against risks that if it goes wrong, it's really a catastrophic loss if you don't have it. Well, think about an annuity. What is an annuity? It's a savings account, I tell people, with an insurance company. You think about everything as a savings account, whether you have money with our firm using TD Ameritrade as the custodian or some other firm, everything's a savings account in some fashion, whether it's an IRA, 401k, you're saving money. An annuity is a savings account, a contractual savings account with a life insurance company. And there are various and sundry kinds of annuities. And we're going to touch on from a 10,000 foot view and then dig down into them. But if you think about it, annuity properly structured, properly used in a person's account is like buying insurance to make sure you don't run out of money, no matter how long you live.
Seems
So
like
that's
reasonable insurance to me, Ron.
that's why annuities are important. Now, as a fiduciary, part of what being a fiduciary means is that you do the very best, always what's in the best interest of the client. Now, if that's true as a fiduciary, then I have a responsibility to people I meet and to clients to say, I don't have a particular dog in the hunt, although I'm a human being and have biases, but I'm not going to just throw out a whole category of places where you can put money, either in investments or bank stuff, because I happen to not like them or my business model doesn't allow me to use them. And that's really what we're going to get into. As a fiduciary, I have a responsibility to everybody listening to today's program, to my clients and people who want to join our firm later, to take a look at the wide world of investments and try to put together a retirement income plan, if you will, that makes sense for each individual, knowing that there's not one size that fits all, that there's no single account that is perfect for everybody, and there's no single type of account that is perfect, meaning it doesn't have any downside. So in putting together a income plan for people and clients and trying to help them, it's important that we don't say, well, I'm not going to deal with this one here because I don't like it, or it doesn't fit my business model. So that's why we're going to deal with the whole program with annuities. It's probably one of the most misunderstood kinds of accounts for a lot of people. But I think if we can make it a little clearer in this next hour, what we're trying to accomplish, I really believe that the more information you give to people, the better they are at making good decisions long term. So before we go any farther, ladies and gentlemen, if you would like to call us, either you'd like to do a review with what you have, get a second opinion, or you want to learn more about what we're going to talk about today and how it might work in your program or might not work in your program, give us a call at 616-301-2581, 616-301-2581, or go to our website, Ron Corser and Associates, and just plug in your question or say, hey, I want a 15-minute phone call. I have a question for you. We will contact you, and I will be happy to talk with you and try to answer to the best of my ability your questions. So again, that's 616-301-2581.
Ron Corser, a certified financial planner, standing by, willing to help you get specific questions answered, issues addressed, get that plan put together. If you would like a course to retirement plan, pick up the phone, give a call now, 616-301-2581, 616-301-2581. I think that the title of the article that you referenced that introduces the topic, very, very playful, just might be the broccoli of retirement planning. Pretty funny. My wife, Ron, is a cook, not by profession, but by passion. And she's got this thing where if I tell her I don't like something, she takes that as a challenge and makes sure to cook it in that way that you can't deny that, yeah, this is actually a pretty wonderful food. And she'll try a few different variations. If I double down and after the first attempt say, no, I still don't like that, she'll try it a different way. With your fiduciary responsibility, Ron, it's not that kind of approach. You are not going to say, oh, well, maybe you say you don't like it, but we're going to find a way to make you like it. This is, you are finding a fit for somebody. And in certain cases and circumstances, annuities can play that part and be that role inside of somebody's portfolio. And we just need to keep an open mind, much like maybe to some of the vegetables or ingredients that we may think about.
It's really important, the part that you said about an open mind, because a lot of times I'll ask people, have you ever heard of something called an annuity? And some people will say, yeah, I heard they're bad. And then my response is, well, what have you heard? Well, I don't know. I just heard they're bad. So what's behind this reluctance, the bad press, if you will, when it comes to taking a look at annuities? And there's many different kinds, just like there's many different kinds of mutual funds. There's many different kinds of bond funds. Not all of those mutual funds and bond funds are right for a particular individual. They have to be fit into whatever the program is or the strategy that we're trying to create for somebody. So what's the reluctance? I think there's a couple reasons for it. One is I think sometimes people overestimate their ability to invest wisely. What do I mean by that? We've had a pretty good run this past year in the market. So sometimes as human beings, this is a really normal way to approach things. Human beings tend to look at the future based on what just recently happened in the past. So we had a great year in 2020, despite COVID, despite all the economic problems. And everybody assumes, well, the market's going to continue to do that. Human beings tend, when it comes to investing, to think what we call linearly. It's going to be a straight line. If it was bad last year, it's going to be bad this year. If it was good last year, it's going to be good this year. So sometimes we overestimate our ability to invest a retirement portfolio in a way that will make sure that somebody doesn't run out of money. But more importantly, I've never been anybody who's going to run out of money. What happens is if you have less money today than you started out with 5 or 10 years ago, what you may do is reduce your lifestyle, because nobody's going to just spend all their money, wake up one day and say, well, I don't have any more money. That's not going to happen. So that's one of the reasons we overestimate our ability to create an investment plan that's going to succeed. One of the reasons is that sometimes the plan is supposedly etched in stone, and no plan should be like that. They're also concerned about what if they don't live a long time? Why would they have an annuity? And that's a concern. I get that. Another topic is that it's confusing. There's a lot of terminology. There's a lot of people out there who have opinions. You can Google annuities and you will get 100,000 different approaches to annuities, from people who say,
14
don't
million.
buy them, they're really bad. I hate them. My brother bought one and he can't get his money out. I've heard all of these. And even I Google on occasion just to see what people are talking about. And other times,
38.5 million results, Ron, actually.
Yeah, it's an amazing thing. But obviously there's something, since there's no perfect investment, and I tell people that there is no perfect investment. You need to know what something does that maybe is good and an advantage for you, and what it doesn't do as well, so that you can create a strategy to maximize the one and minimize the other. So we're going to talk about annuities. I'm going to focus on the different kinds, and real quickly, there are several different kinds in broad categories. There's a variable annuity. That's nothing more than an annuity that has mutual funds in it. You can see the fees, and they generally go from 2 to 4%. A variable annuity is nothing more than another option for the stock market. That's all it is. All annuities, including variable annuities, do something that really other investment accounts can't do, is they can be set up to provide income for you for the rest of your days, for as long as you live. And that's important. That's really important. So a variable annuity is a stock market option, but it can be used to provide income. Then there's another kind of annuity. It's called a deferred annuity. And that simply means you're going to put some money in for somewhere, either bank money or other kinds of money, and you're going to defer taking money out. That's a general category. Inside that category, and this is jargon, and this is where some of the confusion comes from, there's fixed annuities, FIXED. What are those? Those are basically principal protected annuities. Now, if a variable annuity is really just a stock market option, a fixed annuity is not an option for the stock market. And that's where some of the confusion and frustration comes. A fixed annuity is an option for the old time bank money, where you could give your money to a CD and get 3, 4, 5% for whatever you're getting. And if you put enough in there, they'd give you a toaster or a waffle iron as a present. So think about this. A variable annuity is strictly a stock market option. A fixed annuity is a principal protected product. That's just another option for bank money. And inside that fixed annuity are different kinds of other annuities. So we're going to kind of touch on some of this, but keep in mind, ladies and gentlemen, the number one thing an annuity does is it can be properly set up to provide you a stream of income that you can't outlive. It's permanent kind of money, protected money. And that's critical in these days, because people look around and we say, my goodness, we're spending all this money, all that high-priced talent we send to Washington, D.C., just keeps writing checks that we're never going to be able to pay back. And we're worried about this, we're worried about that. An annuity sometimes properly used, and I stretch the idea of properly used and put into a portfolio for some people, takes the worry, as they say, out of being close. It gives you peace of mind without market risk and volatility. So let's get into that and figure out why they work so well, what they do, and some myths that we're going to try to blow up, if we will. Again, this comes from Kipler, so it's not just me talking. I'm the messenger. But understand this, ladies and gentlemen. As a fiduciary, I have to do what's my very best to do what's in very best your interest. My wife, Nancy, and I own these kinds of things. I don't say that as a reason for you to do anything other than just listen to me. But we own them because they do something specific that is important to us, which means guarantee income for as long as we live. So that's one thing. But there's other facts about annuities that I think create a lot of distortion and a lot of uncertainty. So we're going to go through them. But before we do, I'm going to make an offer again. Ladies and gentlemen, if you want to talk to us about anything, about annuities, about your investment program, about creating retirement income, give us a call at 616-301-2581. 616-301-2581. And we'll be happy to chat with you either by phone, using a Zoom meeting, or in person, whatever suits you. That's what we will do. We're here to help.
So Ron, I want to circle back to one of the points that you mentioned of why people are cautious of annuities or may feel like they don't like them. And you mentioned they are worried that they might not live long enough. Now, annuities essentially are longevity protection. If you live a long, long lifetime because of how they're designed to guarantee a lifetime of income, you can't outlive the income. That part, I think people do like. They do appreciate that. In fact, that's why people like pensions. That's why people like Social Security. But the concern there of, well, what if I don't live long enough? I know that in the past, annuities sort of like pensions and Social Security had the quality where if you didn't use up all your money, it might just evaporate. Like with Social Security, if you pass away, your Social Security balance, what you contributed, it does not pass on to your children or your grandchildren. It goes to other people who outlive life expectancies. Annuities tended to behave the same way in the past, but nowadays I think that quality has changed, correct?
It has, and there's a name for what you described. It's a $5 word called annuitization. What it simply means is that somebody turns over a certain sum of money to an insurance company, and they guarantee that as long as they live, they'll send them money. Now, there's different ways to approach the payout. So that the life-only payout, which is the highest payout, that's the one that people are aware of that says, wow, you know, my best friend Charlie got this annuity and he got hit by a bus 4 days later and all the money went away. In my 26 years in the business, pushing 27 now, I think I've only done 5 annuitizations, and that all made sense for the particular client. Rarely do we suggest that that's the only approach to use. So the other approach is that with a deferred annuity, depending on how they're structured, you have the ability to create a stream of income that you can't outlive, but it's not an annuitization. So that simply means is, let's say a husband puts part of his IRA or his 401k into one of these things, and he passes away sooner than later. The money goes, what's left in that account, if it hasn't been tapped even, goes to his beneficiaries. It could be his wife. So she takes it over. She can start taking money out. And a lot of them have options where they will give you a stream of income that they'll guarantee that even if the account goes to zero, and I'm going to get a lot of heads that are going to go, what? That's not possible. But even if the account goes to zero, if they're properly structured, they'll continue to send you money for as long as you live.
And Ron, that specific quality, that's where you mentioned you can't do this with any other type of financial vehicle, a brokerage account, an investment account. a bank account, it's not going to do that. Now, you could theoretically put money in a bank and just live off the interest, but what's that paying these days? 0.01, 0.5%, something like that. And if you started to bring the account balance down and it reached zero, and then you went back in the bank and said, hey, give me some more money, they'd probably end up calling the police on you. But with an annuity, that's specifically what it's designed to do. The account balance hits zero and they keep sending you income.
Yeah, and the way we structure it for our clients, and the way I own them personally, my wife Nancy, is we never lose control of the money. We never give control away to an insurance company. We simply use the options they provided us to provide a stream of income that we can't outlive. So that's why it's important. And a lot of times people are not told that. Sometimes they just say, wow, this is really bad, or I heard they're bad. So one of the things we want to clear up today is that the more you learn about annuities, the more you may find that it could be, I'm not saying it is, it could be appropriate for a portion of your retirement life savings. It might be. There's a great push now with the United States government allowing something called the longevity annuity to be part of a 401k plan. Now, why would the government start to push this? They're not stupid. They understand. You know, it's the guys with the green eye shades that are in the basement of some building in Washington, D.C. doing the calculations. They understand that the American population, the citizens of the United States who've saved money, potentially could run out of money if they don't plan properly. And so one of the things the government's recommending, because they know that Social Security is under some pressure, is think about using an annuity. And if you have the ability to do it in your 401k plan, do it. That's a particular kind of annuity I'm not going to touch on right now because not all many plans like them. But if the government is saying this may be appropriate, if Kiplinger is saying maybe you ought to take time to investigate this, maybe, just maybe, there's something good in here for some people. So let's keep going at it. And it always gets down to this. Whether you're buying a stock, a bond, a mutual fund, an exchange traded fund, anything in the investment world, not every product is suitable to everybody. There is no perfect solution when it comes to figuring this out. So with annuities, the wrong kind of annuity used in the wrong way probably will end up badly. But that's why we're here to help people. As a fiduciary, it's my job to make sure that whatever we do is in the best interest of the people, whether it's buying a stock, an investment strategy, a bond, a mutual fund, whatever it is. I have to be able to say, this is what it does well. This is what it doesn't do well, because nothing's perfect. And here's how we're going to try to mitigate, if you will, or minimize the downside. But the strategy, and annuity is one part of the strategy. It's never probably correct for all of people's money. So we're going to go forward from here. So number one, we've already touched on. Annuities are bad. Not necessarily. Broccoli is not too bad. Liver is bad. Ladies and gentlemen, liver and Brussels sprouts and yellow wax beans from Del Monte, they're bad. The Del Monte people are going to come after me. I just know they're going to right now. So,
yellow wax beans from any company.
Those are the three things we're not going to debate. They're just bad. So we'll go forward. So the other issue that comes up is, well, there's other options out there that do what annuities do just as well. The single biggest myth with this option is that for the cost of an annuity, it's really difficult for somebody to create an investment strategy, say using options contracts, derivatives, things like that, over time that makes sense. Now think about this. If you keep your money in some of these wrap accounts that have, I've seen as high as charge 2%. We don't charge that much, but I've seen them as high as 2%. So let's say you have, Peter, let's go back, you have $10 million, all right? And you want to put some money in the annuity. So we're going to put $1 million into annuity, 10% of your portfolio. And it's going to be in a principal protected account that one day you can use to generate cash flow for as long as you and your wife live. Now, if I was your investment advisor and you were allowing me to charge 2% on $10 million, you could probably take me before the judge as a fiduciary and said I didn't do right. But let's just take that and say, here you have $100,000. That's just where you can invest it in the stock market at 2%, which means some advisor is going to get $2,000 a year. Or you can put it into a principal protected fixed annuity of some kind that makes sense for you. A lot of them don't have upfront charges. Now there's surrender charges in annuities. So we get paid one time. And I've heard it said that, oh my goodness, annuities are so expensive. So let me ask you, let's use some simple arithmetic. You give me $100,000, I'm going to charge you 2%. That's not what we charge, but keep the numbers. So every year I'm going to get at least $2,000. So over 10 years, even if your money doesn't grow and you leave it there, I'm going to make $2,000 times 10, $20,000 on you. So we take that same 100,000 and we invest it in some sort of principal protected annuity. Maybe I get paid 5%. Maybe. So that's $5,000. So over a 10-year period, how do I get paid more? Let me keep all your money at risk and hope it works out for you. And if it doesn't, well, we tried our best. See, that's where one of the problems come in is people say annuities are so expensive. Now we're dealing with principal protected fixed, what are called fixed annuities, different variations. But my goodness, is it better for me to charge that much money to you or to just get paid one time? That's a question everybody has to ask. If they have an advisor who said, we don't like annuities, or better yet, we don't believe in annuities. I don't believe in annuities either. I believe in God and everything else, but annuities are really just another tool in the toolbox. So ask your advisor, why is it you don't like them? And see what kind of answer you get.
Well, Ron, we got to take a quick break, but let's come back and talk a little bit more about that, because I know that there is some conflicting information in the financial world on that in particular. And let's talk about where annuities can fill a role in somebody's portfolio, what they do specifically well, what types we need to understand, what we need to know about them. We've heard they're complicated and complex. Well, let's break through some of that and talk about what you can expect and where and when they might be appropriate when we come back here on your course to retirement, talking about a specific tool today. And as the Kiplinger article states, annuities may just be the broccoli of retirement planning. And so talking about foods we don't like and talking about annuities as well with Ron Courser here on your course to retirement. If you've got any questions anytime, of course, he's a certified financial planner, a CFP, makes his time available to you, makes his guidance and knowledge and help and perspective available to you. No cost, no obligation. 616-301-2581, 616-301-2581. Quick break. We'll be right back with more with Ron Courser in just a moment. And welcome back into the program. This is your course to retirement with Grand Rapids CFP certified financial planner, president and founder of Ron Courser and Associates, your guide here on your course to retirement. He is Ron Courser. And if you do have questions or concerns about your planning, about your financial future, about your retirement plan, pick up the phone and give Ron a call, 616-301-2581, 616-301-2581. Today on the program, talking specifically about annuities. Why are we hearing so much about them? Why is there such conflicting information? What do we need to understand about them? What do they not do for us? And what can they do particularly well? They are a financial tool that's available. And for certain situations, Ron is saying that annuities can play a valuable role, especially in that retirement portfolio. If you are looking for consistent, protected income to last as long as you do. Ron, and again, these specific financial tools, they are specifically designed to provide that lifetime of income. Now, on the other hand, it's been said that they don't often offer a particularly attractive rate of return. So where do those two things conflict?
Well, here's where the problem comes. It depends on what you're measuring it with. So if I want to compare um, the stock that I own to, and it's not called Amazon. If I wanted to compare the growth, I bought a stock 5 years ago, and I want to compare that stock to Amazon. My stock is underperformed probably because Amazon's gone through the roof. So I can then say, well, that was a dumb thing to do because, your stock didn't perform as well. It depends on what I'm, comparing it to. Now, I said earlier in the program that variable annuities are another substitute, just a substitute for another stock market investment. Fixed annuities are the principal protected kind, which include simple annuities, indexed annuities. They're a substitute for bank money. Please understand, ladies and gentlemen, these principal protected annuities are a substitute for bank money. The banks used to give you 3, 4, 5, or 6% and give you a toaster. Well, that's not going to happen probably in our lifetime. So this is where these come into play. This is how they might be useful to somebody. Because, when people used to put money in a CD that paid 5%, they wouldn't touch the principal on that CD for all the tea in China. The reason I know that is my mom used to do that constantly. She'd buy all kinds of CDs. She would never bust them. She would never take out money early. And she might only just roll the interest over. If she needed money, she'd just take the interest out. So part of it is, what are we comparing it to? Compare it to a bank rate of return. It's a good comparison. But the thing that a principal protected annuity does, and I keep coming back to this, is it can be set up to provide income that you and your wife can never outlive. And if you happen to die, both of you die, and there's still money left in there, the money goes to your beneficiaries, your kids, grandkids, whomever you've named. So you never lose control of the money, you never lose the use of it. So when saying that the rates are not attractive, what happens, I think that's kind of a sleight of hand. They're comparing a bank product or a bank substitute with stock market stuff. It's the wrong comparison, absolutely the wrong comparison. So down the road, when you think about it, it's a substitute for bank money, these principal protected fixed annuities, not a substitute for the stock market. So those people, when you hear advertisements say, and I love this because I think they're sold wrong. You hear advertisements says, well, when the market went up, I made money. When the market went down, I didn't lose any interest. I didn't lose any principal. What they're doing is they're selling this thing based on comparing it to the stock market. In my opinion, and it's just my opinion as a fiduciary, I think that's the wrong comparison. It should be made, what's the bank money doing for me right now? Now, another place you can look and say that returns aren't attractive. A lot of people have to hold bonds or like to hold bonds in their portfolio. Bonds are under a lot of pressure. They're not returning a lot. I mean, you can get a corporate bond that might pay 3%, but treasury bonds are paying 1% and sometimes less than that. Principal protected annuities could be appropriate for some people as a substitute for their bond portfolio, simply because the interest rate might be better, just like if they had the comparison to old-time CDs, but the principal is protected. You can lose money in a bond portfolio where you can't lose money in a principal protected fixed annuity.
And I think that is an important distinction, Ron, because in the traditional asset allocation model, the modern portfolio theory, retirees were told to allocate more of their money to bonds to be more conservative and to generate that livable income. Whereas today, interest rates are so low and we have seen bonds lose value many times, that side of the portfolio, the safer, more conservative side of the portfolio, we can reduce the fees, as you've already talked about. We can reduce the risk because annuities don't have the fluctuation with the interest rates, nor can they lose principal value if the market goes down. And a lot of times we can get income that is on par or even higher. Raising income, lowering risk, lowering fees, it seems like a good combination to me.
It is a good combination. The difficulty is that it takes a little bit of time to understand it, to go through it. And what I talk about, it's another tool in the toolbox that we have. Now, one of the scariest places for me as a human being to go is into Home Depot. There's only about 5 things in Home Depot that I really understand: duct tape, a hammer, furnace filters, and windshield solvent, and maybe one other thing. Other than that, I don't know how any of that works. I really don't. So it's always spooky when I go there. But it's just that there's just a bunch of tools in there, right? That I don't have to use because I don't need them for a particular point of view or thing to do.
In all fairness, Ron, you can solve every problem with the ones that you mentioned you did know.
I know that. A hammer and duct tape will fix just about anything. I agree with you. In fact, I even had camouflage duct tape. Did you have any of that?
I've got a whole assortment of different colors at my house.
Yeah.
Yep.
I can't find it because it's camouflaged. I don't know where it is in our garage.
However, Ron, in the financial world, you don't just want one or two tools. There's an old saying about when all you have is a hammer, but that's not the case here. You've got access to the full spectrum. If we continue your analogy, all the tools that are available in the Home Depot, you're just finding the right one for a specific job. And here with this case, there are many tools, but this may be the right option for a specific job.
It may be. And I always understand there's no one tool that's perfect for every solution that you need to have. That's really critical to understand. It really is. So the returns not being attractive, I think that's a false argument. It's kind of what they call a straw man. Depends on what you're comparing it to. Variable annuities, you compare to stock market returns. Principal protected fixed annuities, no matter what variety, you compare to bank money. If you make those two comparisons, you can probably make a more informed decision down the road as to how you want to structure your retirement strategy and income strategy in retirement. So another one here, and it's a really good one, is I can't get my money out. I love this one. I absolutely love this one because people who don't, or advisors who don't offer these to their clients, one of the great things they can say to somebody is, oh man, you put your money in an annuity, you're tying it up. And that sounds like the most terrible thing that could ever happen. I'm tying up my money forever, maybe longer, 2 forevers. So let's kind of unravel this one, this great mystical idea. Number one, there's no single place you can put your money that's correct for all of your money. I firmly believe that. That's called diversification, isn't it? So you can have different kinds of things in your retirement life investment portfolio that do different things. So number two, if you decide to use a principal protected annuity, fixed annuity, indexed life annuity, something like that. Yes, if you put money in there, there is some limitations on how easy it is to access all of it. But the ones that we use, they offer you every year you can take out 10% of what you put in. No harm, no foul. If it's an IRA, you're going to pay some tax, but you have that. What about if you have something terrible happen? You have a chronic illness, a long-term event, or the doctor gives you the long face, Peter, and says, you know what, you got about a year to go, man. Or the worst case possible, you die. Those annuities give, properly structured, if you pick the right ones, they give you all your money back. So if you have to go into a nursing home and you have one of these, they give you all your money back. If the doctor says you have less than a year to live, they give you all your money back. If you have a chronic illness or something happens to you or you die, your beneficiaries get all the money. So you never lose control of the money. There's just some limitations on how much you can take out, which is why it's not appropriate for all of your money. It's that simple. It's that simple. So you never worry about, I can't get all my money. I had a gentleman here one time. He came in and he was a good guy. He ultimately became a client. And he said that he had talked to another advisor, and that advisor said, oh man, you're going to lock up your money. That's a terrible term, lock up your money. It sounds bad. And you're never going to be able to get to it, and it's going to be really horrible. And he'd done well. He had done well in retirement and saving for retirement. So I said, did he say you're going to put all your money in there? And he said, yeah. And I said, why would you put all of your money in any one place?
In anything?
He didn't have an answer. Because
anything.
that's not what diversification is about, is it?
All of your money in one stock, all of your money in the market, all of your money in a bank account, all of your money on a poker hand, all of your money in gold. There's never a right place for all of your money, Ron.
That's absolutely true. Absolutely true. So I said, okay, you're going to lock up your money. So I said, all of your money right now, and he had a sizable 6-figure account. I said, it's all in an IRA. What is the largest expense you could ever have to pay right away out of all your money? And his response was, what if I have to go in I don't know. I had one real life experience where the grandson needed some extra medical help and the parents' healthcare didn't cover it. That was about a $44,000 expense. So I said to him, would if you could take $100,000 out of your retirement program, no matter where it is, would that be fine out of your IRA? He said, yeah. I said, you know what? You can put that in the bank CD if you want to, or you can just put it in the money market. The point is that you don't tie up all your money in anything. The people who use that phrase to kind of scare people are either people whose business model doesn't allow for the use of an annuity, particularly a principal protected annuity. So it's important to understand that. And it's also important to understand that as a fiduciary, it's my responsibility to look at everything out there to see what might fit an individual client. It's my responsibility as a fiduciary. So here's the key question. You have all your money at anybody, TD Ameritrade, Fidelity, somebody. If you run out of money, Peter, if that account goes to zero, are they going to call you up and say, Peter, you're a really good guy. I know you don't have any more money in your account, but we're still going to send you money?
No, they will not.
Even though you are a really good guy. I understand that. But see, that's where a principal protected annuity might fit. Because here's something, ladies and gentlemen, I'm going to say, and some people are going to say it's too good to be true. But if you would like to come in and talk about it, I'll show you why it isn't too good to be true. Even if that account, you live so long and you take money out of that account properly structured is the key. And that account goes to zero, they will still continue to send you money. It's not too good to be true if you understand how it works. So if you have that question, how can this be true? Come and see us. Give us a call at 616-301-2581, 616-301-2581. Be more than happy to talk with you, to show you how these things work, just to answer your questions. You may not want to do it, but man, wouldn't it be nice to have the clear kind of understanding of how they do work? Because maybe down the road, sometimes it may be appropriate, who knows? So give us a call, 616-301-2581. Be more than happy to help you with this.
616-301-2581. Ron, I think that is where there is a lot of angst about annuities and sort of misunderstanding, is that we're always told annuities are complicated. Annuities are so complicated. Well, I'm not sure if anybody reads that several hundred-page prospectus about how their mutual fund works and operates. That, to me, is very complicated. But there is an element of a mutual fund that's not too complicated, which is if I don't want it anymore, I can sell out of it, and generally it is liquid within 24 to 72 hours. There are some limitations with the accessibility to annuities. I am hearing you say that, but there's also a lot of flexibility under certain circumstances or within limitations. And with the principal protected annuities that you talked about on the program and that you utilize, there's a lot about them that's not very complicated. You're not going to lose money if the market goes down. You can start and maintain and count and rely on an income for life. And with many of these, you have some amount of guaranteed growth on them until the time that you intend to use them for income. So a lot about them that's not very complicated. But still, there is the conflict in the financial world of kind of talking about one product or promoting it and then maligning another one that I think muddies the water, so to speak.
Yeah, it does. It does happen. And it's a great analogy saying, has anybody ever read the prospectus for a mutual fund? And you find out that mutual funds can engage in derivatives and people go, my goodness, what's that? Well, we're gonna get a little complicated with the mutual fund. So it's important just to focus on saying, number one, what is it that I want my money to do for me? Really an important question. What do you want your money to do? Most people say, well, I want it to grow. I don't want to lose it. I want it to last. Okay, if that's what you want, let's take a look at all the different kinds of buckets, so to speak, or places you can put your hard-earned retirement money. So does it give you a rate of return? Does it protect you? Does it give you income that you can't outlive? Does it do the things you want it to do? Chances are, if you really have an advisor like us that takes you through that, and we dig down deeply, you find out that there's nothing perfect. So the real key to building a good retirement plan is to take all these imperfect things, stocks, bonds, mutual funds, annuities, all of that, real estate, and put them together in such a way that the overall strategy gives you the best opportunity to have the income you need to maintain your lifestyle. You know, we say, well, how are we going to take care of inflation? That's nothing more than saying, how am I going to make sure that my lifestyle survives the next 5, 10, 15 years? You need income to do that, and income perhaps on an increasing basis. So the key is, how do we put it all together to make sure that you have the single best opportunity to give you the best chance of being successful in this thing called income retirement? It's incredibly important, because the government is going to do all kinds of things to us. We know that. Some are going to be good, some won't be so good. But we need to understand what's the best approach for me. Now, here's a little caveat. Just like stocks may not be appropriate for everybody, perhaps an annuity isn't appropriate for everybody. But why not take a look at it and see if it makes some sense to you? Because I don't know, as a financial advisor with 26 years in this business, I don't know where else to go where I can look somebody in the eye and say, if you put some money into this thing called an annuity, the principal's protected. As long as you follow the rules on how to take money out, you won't have a loss. And it can be set up and structured in a way that will give you income for as long as you live. Now, the key may be you haven't put enough into an annuity to get all the income you need, but it's like Social Security. Not many people live totally on Social Security. So it's the same kind of analogy. It's
Building
going to give you
blocks.
money
You're
that you can't
stacking
outlive.
income on top of other things. You're
Absolutely.
putting pieces together.
Absolutely. Absolutely. So when it comes to dealing with how do I create a retirement income plan for myself, there's a lot of tools out there, ladies and gentlemen. It just gets down to working with somebody who's open enough to say, you know what, I'm going to open up the whole toolbox. Let's see what works for you. Let's see what makes sense for you. Let's see what gives you peace of mind. And I'll help you understand it. So it's not just, I hope. You don't want to build a retirement plan that says, I hope this works. Hope is a nice thing to have, but it's not a good thing to just put your whole life on. So you have to have some assurances, some guarantees. And that's what using an annuity will do for anybody who is thinking about generating some income as they go forward in life and in retirement.
Well, I think that we all are probably going to need some amount of income to get through retirement. On the day we retire, it doesn't mean we suddenly don't need an income. It means we don't have an income. And there are some sources that will provide us with that income. Social Security, obviously, being the most common, but generally that doesn't provide 100% of what we need to maintain our standard of living and our lifestyle. That's why during our career, we have saved, we have invested, we have put money away in those retirement accounts. And Ron, this generation, as they are transitioning to retirement, realizing that they don't have the pensions to complete that picture, and that taking that investment account that has been purposed for growth, that 401k or that IRA, and trying to time the market, trying to navigate the ups and downs of the market, relying on steady trajectories of growth, that simply is not reliable. And they're looking for other solutions to ease the fear and the concern of running out of money. This may be one of those solutions, at least in part, of your total financial picture. And I think that's why this financial tool, this subject, annuities, deserves the time and attention that we gave it today on the program.
Yeah, it's a go-to tool for us. We don't use it with everybody, but we always tell people we're going to take a look at everything we have in the toolbox, figure out what works for you, figure out what makes sense for you, give you the best opportunity, the best probability of success. And isn't that all we're looking for? Let's put all this together. I know the future's uncertain, but give me the best probability of success. And that's what we can help do. So, ladies and gentlemen, if you're out there wondering if you have a retirement plan that's going to give you the best opportunity for success, that's going to give you the best opportunity for money that you can't outlive, give you the best opportunity to maintain your lifestyle. And isn't that what we're talking about? In retirement, how do we maintain our lifestyle going through all the ups and downs, the uncertainty, all of that? How do we do that? We can help. We can help you create an investment program, a strategy, if you will, in retirement that'll produce growth so you can stay ahead of the world, that will give you the income that you need, that will protect a good portion of what's coming in and give you the very best probability of success. And that's all we can guarantee is the best probability of success. But the other thing we'd say is that you don't get left hanging with us. I mean, it's not a one call, have a nice day, we'll talk to you next year. We stay in touch with people. We have to make adjustments sometimes in portfolios because the world around us changes. So it's what we do as a company. We create investment strategies that make sense for people, that give them the best probability of success, that gives them the income that they need, that gives them an opportunity, if they want to provide a legacy for children or grandchildren, to provide that legacy without minimizing their own lifestyle or giving up something that's important to them. So we can help with all those things. You know, right now we're in a tax season, and people are saying, oh my goodness, you know, how do we make sure we're doing well on taxes? Did we get a refund? If we got a refund, we did good. If we didn't get a refund, well, that's not good at all. There's more to tax planning than that. And just like there's more to creating an investment strategy, an overall strategy in retirement, it's more than just doing one thing. So give us a call, ladies and gentlemen, 616-301-2581, 616-301-2581. We'll answer your questions if that's all you want. If you want to come in and talk with us, we'll do that. If you want to do a Zoom or go to meeting, we'll do that too. But we're here to help you. And I believe we can help everybody if they're just open enough, and we help and we be creative enough, if you will, to find out what's important to you as an individual. Not a one size fits all, but what's important to you. What are you trying to accomplish? When do you need the money? How much do you need? And where do you want it to come from? We can create a strategy that will handle those questions for you, so it'll give you the best probability of success. And if you have that, you'll have some peace of mind, which is really critical these days.
Well, if that's what you are looking for, if you'd like guidance, if you'd like the perspective of a CFP, a certified financial planner, if you would like a resource on your side that has that fiduciary responsibility to you and your best interest, pick up the phone, give Ron Courser and Ron Courser and Associates a call. Ron is here as the resource for Grand Rapids area savers and investors. If you're planning and taking your financial future seriously, he offers his time. He offers his guidance, no cost, no obligation, and he will help you craft your course to retirement, the plan, the document that gives you a snapshot of where you are after a discussion of goals, writing those down so that you can work to achieve them, and the step-by-step instructions on how to do that. Just pick up the phone to get started, or if there's simple issue or question that has been on your mind related to your money, 616-301-2581, 616-301-2581, 616-301-2581. Ron, as always, an informative hour moves by quickly. We appreciate your guidance and the time that you invest with us here on the program to help bring education and awareness to savers and investors across Grand Rapids. Thank you very much.
Well, thank you. And thank you for everybody listening to today's program. Give us a call if you have any questions of any kind. We're more than happy to chat with you. Other than that, have a blessed week.
Tune in to Ron Courser's full radio program, A Course to Retirement, Sunday mornings at 9 a.m. on WOOD, and visit roncourser.com for many valuable resources, including other great episodes of Your Course to Retirement.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor.
Ed Slott's Elite IRA Advisor Group is solely an indication that the financial advisor has attended training provided by Ed Slott and Company, passed biannual examinations on material covered at conferences and in webinars, and met other membership requirements, and does not constitute an endorsement of any kind. Ed Slott's Elite IRA Advisor Group members pay a fee for the educational programs that allow them to be included in the Ed Slott's Elite IRA Advisor Group. Membership does not guarantee investment success. Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals or growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes. Advisory services offered through Brookstone Capital Management, a registered investment advisor.